Hewlett Packard Enterprise just essentially time traveled. They basically pulled their entire 2028 financial target framework all the way into today. You are listening to Earnings Unscripted. Today is June 1st, 2026, and we are looking at HPE and their Q2 earnings, which honestly feel like they were written by an AI. Literally.
Well, actually, parts of their company kind of are now. But yeah, look, it is very rare to see a legacy hardware and server vendor rip higher by roughly 40% in a single after-hours session. The price action is just absurd.
40%. That is... Okay, hold on. Before we get into why the market completely lost its mind on this, I have to do the quick legal thing. This is not financial advice, just our personal opinions, so please do not sue us. But Miro, 40%. The stock had a great quarter anyway, trending up to close near its period high around $28. Then today, they close regular hours at 47 and just explode past 60 after the bell?
It actually peaked at 65 right as the earnings call started. And, I mean, the headline numbers do give you whiplash. Revenue came in at $10.7 billion. That is up 14.8% from just last quarter. Non-GAAP EPS was 79 cents, up from 65. And operating margins ticked up to 13.3%. So they are clearly, definitively making money.
And they are making it off servers. The cloud and AI segment hit $7.7 billion. The AI server part alone jumped almost 29% sequentially. So they are practically printing cash in that division.
Right. They are finally converting that massive backlog we talked about last time into actual recognized revenue. But there is a very, very big catch here.
Of course there is. You never let a good quarter just be a good quarter.
Well, I actually look at the segment breakdowns. Everyone is cheering about AI compute, but the data center networking revenue actually fell. It dropped nearly 28% from last quarter, down to $320 million.
Wait, but I saw in the report that data center networking orders were up roughly 20%.
Exactly. Orders are up. Revenue is down. They still literally cannot get the silicon components to build the networking gear. Antonio Neri basically said supply availability is not going to improve in 2027 at all. So the ceiling on their growth is entirely physical right now.
The bottleneck economy strikes again. But they did find one very modern way to cut costs. CFO Marie Myers said generative AI is driving 20% of their internal savings now. They basically slashed their contractor base by over 90% using Agentic AI.
Yes, they are quite literally replacing their human operations desk with their own autonomous software. It's brilliant for the balance sheet, but completely brutal for the contractors.
It's eating your own dog food taken to the absolute extreme. All right, let us get into the details on these supply bottlenecks and what Elliott Management suddenly joining the board means for their future.
Usually an activist investor like Elliott Management, they force their way onto a board when a company is fundamentally broken.
Right. The ship is sinking, so you call in the ruthless turnaround guys.
Exactly. But here, HPE is quite literally outperforming. Chris Hugh from Elliott just took a seat on the strategy and finance committees right as the CEO, Antonio Neri, says they are bypassing their entire long-term financial plan.
Bypassing it how? Like slightly beating it?
No, obliterating it. Neri actually said on the call, let me just find the exact quote. Yes, here. He said they now expect to significantly exceed their original fiscal 2028 earnings target and generate at least $3.5 billion in free cash flow 2 years ahead of plan.
Wait, they are hitting fiscal 2028 goals right now in 2026?
Yes, it is practically unheard of for a legacy hardware business. So your natural question should be, well, why does Elliott even need to be in the room if management is already pulling off a miracle?
Right. I would think you just let them cook at that point.
Cash. Sudden, massive amounts of cash.
It always comes down to someone not trusting someone else with the wallet.
Bingo. Just a few days ago, on May 28th, HPE completely exited their joint venture in China. It was called H3C. They sold off their final 19% equity stake and just pocketed roughly $1.35 billion in cash.
Oh, wow. So Elliott is sitting there making sure management does not get, overly creative with $1 billion windfall?
They want that debt paid down. Management has a 2x net leverage goal, and Elliott is essentially sitting at the table saying, please do not go buy another random software company, just pay the bill.
Fair. Although they did just buy Juniper Networks, and I remember people being pretty skeptical about that integration, but Neri actually called it a home run on this call, right?
He did. He claimed it is a big source of shareholder value creation. And honestly, he might be right, because they are combining Juniper's AI network software with their servers to build out these private sovereign clouds.
Okay, wait. Sovereign cloud? That sounds like a James Bond villain lair.
It kind of does, but it just means isolated, completely air-gapped infrastructure. Neri actually made a point about this. He said he does not just picture massive gigawatt factories for AI. He thinks of deployments that act as a sovereign and are governed under local law.
Oh, like the Dallas Cowboys.
The what?
No, seriously, this was in the notes. The Dallas Cowboys literally built a private cloud using HPE hardware. They did not want to put their proprietary sports data and analytics on a public cloud. That is a sovereign cloud in action, just, for football.
Okay, yes, that is a perfectly weird, highly American example. But yes, it is localized computing.
But this loops back to your point about margins, Miro. To make these private networks actually run without an army of IT guys on staff, the software has to run itself, which brings us right back to the agentic AI they use to automate away their own contractors. They are just selling the exact same automation out to clients.
Right. You're actually spotting the control system feedback loop here. If you layer Juniper's software over HPE servers, you theoretically auto-manage the network. The UK Ministry of Justice just did this. They integrated HPE's agentic tools and apparently saw a 75% reduction in support tickets hitting their human IT desk.
Geez, 75% less human intervention. If you are an enterprise customer staring at exploding labor costs, that is a very easy check to write.
Which perfectly explains why they can pass rising memory costs onto customers and still push gross margins to nearly 37%. They have pricing power because they're selling automated labor, not just metal boxes.
Okay, so they have over $1 billion in fresh cash from the China exit. They're beating targets by 2 whole years, and they're basically proving out the automated IT thesis in real time. So where does this actually leave them heading into next quarter?
Well, it leaves them guiding significantly higher. Management is projecting Q3 revenue between $11.5 and $12.1 billion, and they bumped the full year earnings guidance up as well.
Wow. Okay, so the physical bottleneck is not exactly sinking the ship.
Right, because of their pricing power. But the most telling part was Antonio Neri's outlook for the long term. Let me read you this quote. He literally said, "If supply improves in 2027 with the momentum and demand we have, we may have an upside." But then he immediately added, "I will tell you, I do not expect the supply availability to change in 2027 that much."
Jeez, so he is just flat out telling everyone to stop hoping for a supply chain miracle anytime soon.
Exactly. The constraint is basically permanent for now. But they are managing it by accelerating their entire financial timeline. They actually threw out an early 2027 framework already, predicting free cash flow will hit at least $4.5 billion next year.
It is just wild when you step back and look at it. We are watching a legacy hardware giant use the exact AI they're selling to shrink their own human workforce, just squeezing out margin because they literally cannot get the parts to build more boxes.
Yeah, it's a forced evolution. If you cannot scale your physical volume, you have to crush your operating costs. And now you have Elliott Management sitting right there in the boardroom to make sure that margin actually goes toward paying down the debt.
It is a beautifully brutal system, honestly.
It's entropy with better marketing.
Although I have to give them credit, it's working perfectly right now. Neary claims they have absolutely zero cancellations in their backlog.
Which is the dream scenario. Real demand, tight supply, and zero fluff. All right, I think HPE has officially figured out how to play the bottleneck economy. Miro, it is always a pleasure taking apart the machinery with you.
Always. We'll see if that cash pile actually goes to the debt by next quarter. Bye, everyone.
See y'all next time.
If you want these little earnings teardowns to just quietly drop into your feed, hitting follow on the podcast app is definitely the easiest way. And just as a quick aside, while Miro and I are AI-generated voices built to simulate human conversation, the actual data and filings we unpack are completely real. If you have a specific ticker you want us to rip apart or just some feedback, shoot us a note at earningsunscripted@datamadness.ca. Thanks for hanging out. We really appreciate it.
See you next time.